Well, good afternoon, everyone, and thank you so much for attending this webinar. My name is Kate Clark, and I'm a qualified accountant turned headhunter in the financial space. So we specialise in placing finance directors, CFOs, heads of finance, basically the top level finance person in growing businesses, typically in the SME space. And that could be in-house as a permanent or on a part-time fractional basis. And through working with our clients, it has become a little bit apparent that there's a bit of a gap in terms of understanding their finances. And so last year we sort of started doing these webinars to help business owners sort of understand sort of various aspects. Sometimes it's just me, like today, so sorry about that. But other times I'm joined by experts in their fields. And actually, next month, I'm going to have a financial services specialist, so someone who has had their whole career in financing of businesses. So if you are looking to get some money into the business in the form of sort of loan or equity, then she's going to run through sort of the different options that you have. But in terms of today, the plan is, all being well, that we're going to go through sort of the three key financial statements, explain the difference between them, and also how they interrelate. And then we're going to be looking at the profit and loss in a bit more detail and get an understanding of why it's so important to look at the net profit margin, and also look at sort of how pricing decisions can have an impact on this. And we're also going to take a look at the key aspects that banks and investors tend to look at when they're sort of looking to give money to businesses, with a particular focus on EBITDA and why that's so important. And then finally, assuming we have time, we're going to run through some examples of what good management accounts look like. So without further ado, we're going to get onto the financial statements. So basically three key financial statements that all large companies have to submit, prepare and submit to Companies House. If you're already comfortable with these, then go make a cup of tea and come back in about 10 minutes or so when I should have got on to the more exciting stuff. But if you want a refresher or don't know what they are, then now's the time to listen carefully. I should also point out, actually, there are exemptions for small companies in terms of what they have to submit to Companies House. So if you're looking at sort of a potential customer or supplier and they're a small company, you will only get limited information, unfortunately, from Companies House. But I'm going to talk about all three anyway, because it's useful to understand what they are and how they interrelate. Now, in accountancy, there's a lot of terminology that I believe is designed to confuse the average Joe Blogs. And if I was being cynical, I would say that accountants do this to keep themselves in jobs by making things overly complicated. But obviously that isn't the case. But no, so for example, let's say, like I've already mentioned, financial statements, but they can also be called your accounts, but also your internal management reports can be called accounts. So, you know, it's different terminology, basically the same thing, but there is a difference between your management accounts and your financial statements, your statutory financial statements that get submitted to Companies House. As I said, I'll talk about the management reports later on in the webinar. So for now, I'm going to talk about the sort of the three financial statements that large companies are required to submit. And these basically are the income statement, which is also called the profit and loss. Second one is the statement of financial position, which is also called the balance sheet. And then you have the cash flow statement, which the statement is actually different from a cash flow forecast, which I'll also come on to talk about in a bit. So, as I said, income statement, also called profit and loss account, and generally in the SME world in which we operate, it tends to be the profit and loss account tends to be used more frequently more commonly than the income statement. So I'm going to use that from now on. And similarly with the balance sheet, I think that's just a more common and understood terminology. So the profit and loss account will show a summary of the performance of the business over a defined period of time. So it will always say on there over what period it is, whether it's a month, whether it's a quarter, or most commonly a year. So when you submit to Companies House, that will be your profit and loss account for the year, unless of course you've got a long period of account or a short period account for that year. And as I said, I would say most business owners are familiar with the profit and loss account, and they tend to hopefully review them reasonably regularly. But often the focus is on the wrong numbers, which I'll speak about in a minute as well. So in terms of what do we mean by performance? Well, performance is essentially what you have earned in terms of your sales or revenue or turnover. Again, different names meaning the same thing. And what you have incurred in terms of your costs or expenses or overheads. Again, similar terminology, slightly different emphasis on things, but meaning the same thing. And the difference between what you have earned in terms of your turnover, less what you have incurred in terms of your costs and expenses, the difference is your profit for that period. And obviously, if you've incurred more costs than you have earned in terms of your revenue, turnover, then that would give you a loss for that period. Now, the key thing here, excuse me, the key thing here is that actually it's the net profit figure, which is the most important number. And people often focus so much on the revenue, the turnover, and it's the net profit that is important. If you are generating revenue, but it's unprofitable, then you do not have a sustainable business. You will constantly need injections of cash to keep that going. And it goes back to the old adage of turnover is vanity, profit is sanity, which I'm sure you've heard of, but this is what it's talking about. So if you're generating sales and they're at a loss, you are in trouble. And this is why the profit and loss account is so important and why investors will focus on that EBITDA figure, which I'll come on to a little bit later on. As an example of this, when I was in the corporate world, when I was in a facilities management business, and typically those businesses, they're pretty low margin businesses, so like 3 to 5% net profit. And they were a very acquisitive business, and they acquired a highly profitable consultancy business where the turnover was significantly less than some of their other acquisitions, but the net profit was much higher. Well, actually, the gross profit was much higher as well. And I remember having a chat with the business owner, the founder of that consultancy business. I remember him being like really irritated by the fact that like some of the MDs of some of the other businesses thought they had much larger businesses because they were always quoting revenue figure of like X million compared with his much smaller amount. But actually, when you looked at the bottom line and you looked at the net profit, he had a much bigger profit than they did. And, it's quite funny that, they felt superior to him, but actually he was the one that was laughing last on that. So when we talk about profit, we talk about the net profit, that has three main jobs to do. The first is to pay your taxes and to pay off any loans that the business may have taken. The second is to build up reserves. So build up a buffer so you can protect yourself from a downturn, or if you want to invest in growing the business, but you don't want to get external funding. And then the third is to give you, and if applicable, other shareholders, a return on your investment or their investment through paying out dividends. But as I said before, business owners often focus on the top line and they forget about the other costs associated with running their business, and they don't think about that net profit. I'll talk about that a little bit later on, but for now, let's go on to the second financial statement. As I said, the second one is the statement of financial position, which is most commonly referred to as the balance sheet, certainly in the SME world. And the balance sheet provides a snapshot about the financial health of the business. And it provides details of everything you own, which is essentially your assets, less everything that you owe, which is your liabilities. And the difference between your assets and your liabilities is your equity. So if you think about it with your house, if your house is worth 500,000 and you've got a mortgage of 300,000, so that's your liability on it, then the amount which is your equity in that house is the 200,000. So obviously, if your assets are more than your liabilities, then you are in a situation where you've got equity. And if you've bought a house that actually then, let's say, devalues, then you're in that awful situation of negative equity. And I did a whole webinar on the balance sheet on this and other elements to do with the balance sheet with one of our fractional finance directors, Ramsey. So I'm not going to go into loads of detail here about it, but I do want to bring up a couple of slides that I'd used in the webinar with Ramsey. And if I can work it out, I'll put a link in the comments just to highlight the key points here in terms of what to look for. So bear with me. So here we've got a balance sheet, statement of financial position, whichever you want to call it, which is not looking particularly healthy, because we've got a situation where our current liabilities is actually more than our current assets. So we have got a negative net working capital situation, which means that we're likely to have liquidity issues, okay? Because in the short term, we're needing to pay out more than we are expected to come in, okay? And this balance sheet is particularly bad because it's also got a negative retained earnings situation. So basically means that it's incurred losses in the past, which have then created that shareholders deficit, if you see there on the bottom line, okay? So it's always good, I think, if you're working with any new suppliers or customers, to take a look at their accounts, their financial statements that are held on Companies House. So if you go to the Google Companies House website, and you can search and find their financial statements. If they're a small company, as I said, there are limited disclosures, so you won't necessarily see their profit and loss account if they're a small company, but you will always be able to see their balance sheet. And the key things to look for are the shareholders' funds. How healthy does that look? Is it negative? And also, are they in a net current liability situation? And let me just stop that. So in terms of then the final financial statement, as I mentioned earlier, is called the cash flow statement, which, as I mentioned earlier, is not the same as a cash flow forecast. Can't iterate that enough. I'll give an example of that later on. But the cash flow statement, not the forecast, the statement, is very much like a profit and loss account in terms of it shows the performance of the company over a period of time, or it shows the cash flows of the company over a period of time. And that time frame will be the same as your profit and loss account when you're preparing all three statements together. So if the profit and loss account is for a year, then your cash flow statement will be for the same year. Likewise, if it's for a month, then you'll do it for a month and a quarter, etc. And as it implies in the title, the purpose of this statement is to show where the money is being spent, or has been spent, I should say. So it is a backwards looking report. And the accounting legislation dictates certain categories for each type of transaction that a business will make. So every item that goes through the bank as a cash transaction needs to go into, for a small business, one of three categories, which are basically operating activities, financing activities, and investing activities. So the majority of transactions will go into operating activities, but if, let's say, you got a loan or you're making interest payments, then that will feature in the financing activities line. And if you are investing in fixed assets, let's say, or you bought another business, then that will go into your investing activities. But as I say, most of the cash flows will go into operating activities. Larger companies excuse me, larger companies have to disclose a lot more detail in their cash flow statement, but for smaller businesses, it's just these three. And I would say that the cash flow statement isn't that useful for business owners. It will tell you where you're generating cash, but it's very much a backwards looking report. And I think that the cash flow forecast is a much more useful report for business owners. But investors and the banks will look at your cash flow statement to sort of see historically, what has happened. It does give insight into what has actually happened in the business. And I would say that the final point that I wanted to touch on here is really how these three financial statements, how they interrelate, because I think people sometimes get a bit confused about that. So bear with me while I just pull up my slides again. So here we go. We've got a very, very simple transaction. So let's say that we have made and it's important to say, a non-cash sale to a customer for £100. Okay, so this is a sale on credit, and we have provided the goods or service and raised an invoice. So we have we've recognised this income at this point in time. I should point out that there are lots of rules around revenue recognition in accounting. I'm not going to go into details about them now, but basically, some things don't get recognised when you raise the invoice. But let's assume that in this particular case, when we've raised the invoice, we've provided the service, all good, and it is recognised at that point in time in the profit and loss account. So as you can see there in the middle column, we have recognised revenue of £100. Okay, and at the same time, when this gets recognised, we have also created a trade debtor in the balance sheet, which conveniently is also known as the accounts receivable. So I've shown it there as accounts receivable, but trade debtors, accounts receivable. Another example, two different names meaning the same thing. So we have then created a debtor in the balance sheet. But as you can see, it's really important to note at that point in time, there is nothing in the cash flow statement because we haven't received the money yet. It's just an imaginary, well, not an imaginary because we've made the transaction, but it's a paper transaction at this point in time where we've recognised the revenue for £100 and we've created a debtor in accounts receivable. No cash, nothing in the right-hand column, okay? But when the cash then comes in from your customer, so you've got an amount of £100 in your balance sheet as a trade debtor, accounts receivable. When the cash comes in, then the balance sheet, the asset that was that debtor, that trade debtor, gets converted into cash. So your trade debtors, accounts receivable, will reduce by £100 and your cash balance will increase by £100. And because it's a cash transaction, it will then also appear in your cash flow statement within the operating expenses line or operating cash flows, as I mentioned before. But it's really important to note here that it's a cash transaction. Sorry, when the cash comes in, you do not have any impact on the profit and loss account because the profit and loss gets impacted or the transaction happens in the profit and loss account when the revenue is recognised, okay, not when the cash comes in. So that's why it's greyed out for that particular bit. When that sale is recognised, the costs that are associated directly with that sale, that go into cost of sales will also need to be recorded. Okay, so in a more advanced accounting systems, that will happen automatically, but for others, it happens through a manual adjustment in the accounts through a journal. So let's say in this particular example, the cost of the item that we sold was £50. So when that sale gets made, that cost gets recognised in the profit and loss account as a cost of goods sold. Cost of goods sold can also be called cost of sales as well. Again, just to confuse things, okay? And that it is shown in a profit and loss account at the same time because we are matching the cost with the sale, with the turnover. I'll talk a bit more about the matching concept later on, but it's like a really, really important point. Now, at that point in time, assuming that we bought the stock in advance, the item, the cost of that item would have been held in the balance sheet as stock, as an asset, okay? And so when we make that sale, we then are making a reduction in our stock. That's why it's -50. So we're taking it out of stock and we are putting it into the P&L as a cost of goods sold. But importantly, cash flow column greyed out because there is no impact on the cash flow statement as no cash has been paid at this point in time. And it's only when the supplier gets paid do we see an amount going on the cash flow statement. But at that point in time, there is no impact on the profit and loss account because the profit and loss account gets impacted when the transaction gets recognised at the same time as the revenue, okay? So when that supplier gets paid, the balance sheet will reduce the amount of cash it holds. So we're paying cash, so it's coming out of the asset that is cash. And we're also reducing the creditor balance. So when we bought the stock, we would have then put an amount against the creditors or accounts payable of the amount of the stock. So when we are paying that to our supplier, our creditor, same thing, different name again. When we are paying our creditor the £50, then that will then reduce that liability in the balance sheet. So that's why then you've got accounts payable going down by £50 as well. All of these transactions basically get processed using a system of debits and credits, which you probably have heard about. It's the language of accounting. I don't want to go into loads of detail on this because it is confusing. And in most accounting systems, a lot of the transactions happen automatically when you post an invoice or you raise an invoice. It happens behind the scenes. So as a business owner, you don't need to know them. And it's, it takes quite a while to get your head around it all. But I'll just sort of run through the key principles, which is basically that a debit in the balance sheet is good, whereas a debit in the P&L is bad, and a credit in the balance sheet is bad, whereas a credit in the P&L is good. Oops, gone too far. So that is, I think, all you really need to know about debits and credits, and that the manual adjustments to your accounts get done through a journal, through journals, and each one of those journals will have a debit to one account code and then a credit to another. And that could be moving things from the profit and loss to the balance sheet, or it could be a reclassification between the profit and loss or a reclassification between the balance sheet. And this is where things can go a little bit wrong because it gets a bit complicated and you have to stay on top of what you've done historically. I'll come on to give an example of that later on, but it's just to make you aware that the accounts can get in a bit of a mess if you have someone who is processing journals and they don't necessarily know exactly what they're doing, which unfortunately does happen. As I said before, cash flow sits outside of the normal accounting system. So it only records the cash. So it's a bit like your bank statement, but with classifications for the different types of transactions. Okay, so it only records the cash. And so the debits and credits only relate to your profit and loss and balance sheet. They're the ones that you're doing your debits and credits to. So just as an example of a credit being good, for example, in the P&L, in the example that we just had, when we made the sale, the profit and loss account would have credited, there would have been a credit to the revenue or turnover of £100. Okay, so credit that £100, which, as you can see there, is good. And the balance sheet would have debited the accounts receivable or the trade debtors, which again, as you can see there, according to our rule, is good, which makes sense because it's good in the balance sheet that you've debited it because it represents future cash that is coming into your business. When your customer pays you, that's future cash coming into your business. And the previous example gives, I think, a really simple way to understand how money can easily get tied up in working capital. So a lot of business owners don't realise how if you grow really quickly and you haven't got your working capital under control, you can still be profitable, but you run out of money. Now, we covered this in a lot of detail in the webinar with Ramsey a few months ago, so do take a look at that. But as I was preparing this, I was thinking this is a really easy and simple way to sort of understand. So let me just move on here. So I've changed the figures on the right-hand column to show that, let's say we go back to our previous example, but in the right-hand column now, we have actually bought 3 items of stock in advance of the sale that we made. So your supplier payment, you had to pay your supplier, and let's say you pay them in advance of actually making that sale because you've got some stock in ready to make sure that you've got it to then sell. So you've made that supply payment of £150, so 3 times the 50, okay? And the other 2 items of stock amounting to 100, the £100 are kept as stock in the balance sheet. So when you make that sale, you've then still got 2 items amounting to £100 kept in the balance sheet. But as you can see, if you've paid that supplier before you've made the sale, then actually you've got £150 going out of your business before you've even got any cash coming in. And let's say that your customer is then late paying you, that makes it even worse. So if you've got stock, you're buying it in advance, you're making those payments in advance, then you're quickly going to be in a really difficult situation. You're going to need to finance that again and again and again, okay? And that's why it's really critical to keep your stock management under control. So earlier on, I mentioned that business owners often forget about the other costs associated with running a business, and they don't always think about that net profit. And a really good example of this is showing the impact of how, if you offer a discount, how that impacts like the bottom line. So just moving on. Here we go. we've got an example of this. So here we've got let's say you've got a really profitable business, so 70% gross margin. That's really, really good. And let's say your monthly revenue is 100,000, and your monthly profit and loss account looks like the left hand, the table on the left. So you've got cost of sales 30, gross profit 70, overheads 40, with a net profit of 30. So you've got a really good net profit margin, 30%. Okay. And then let's say that you agreed to offer a discount of 30% to all of your customers. So all of them have now got a 30% discount. And your results could look like that on the right hand side. So here your 100,000 is now only 70,000 because you've times it by 0.7, so 30% has been taken off. And your cost of sales, however, they don't get reduced because it still costs you the same to buy that item. So your cost of sales is still 30, which means that your gross profit has now gone down to 40 instead of 70. And because your overheads are actually 40,000, you've now completely wiped out your profits for the month. So that 30k has essentially gone straight to the bottom line. It's taken off your 30, so your 30,000 net profit that you had is now been completely wiped out. And that's exactly why you need to focus on the net profit more than your gross profit. I know what you're saying, Kate, but if I give a discount, I'm going to get much more sales. And you might do. But interestingly, you need to make a lot more sales than maybe you think you would. So let's have a look at the next slide there we go, where we've got the situation on the left where we've now done the discount. So this was on the right hand side on the previous slide. So we've now got the wiped out profit on the left hand side. On the right hand side, let's assume that we've made now with 10%, the volume increases by 10%. Okay, so not a big amount. And you have a look at what this looks like. So your turnover now is 77. So you've got that 70 that you've got from the discount times by 1.1. So you've increased it by 10%. But also your costs now increase by 10% because you've got 10% more volume. So you've got the 33, so 30 times by 1.1 or 110%. And then your overheads remain the same and your net profit remains the same. I should also say this is very simplistic and it's ignoring the fact that you might have direct costs that don't feature in cost of sales. Another unnecessary complication, I should say, with accounting. Sometimes you have some costs that are directly related to your sales, but the accounting rules to tell you that you don't put them in cost of sales, you have to put them in overheads below the gross profit line. This is ignoring that. This is just sort of saying that, all of your direct costs in this particular example feature in cost of sales. So just wanted to point that out. So here you can see a 10% increase in sales is only giving you a £4,000 net profit margin. So, compared with what you had right at the beginning, which was a 30% profit margin, a £30,000 profit, you have decreased your net profit by a whopping 87%. So, that's massive. And if you do the maths, and I think I've got this on the next slide, it's only after you've increased your volume by 75% will you have got the same net profit as you did before the discount. So I've now brought up on the left-hand side our original situation where we've got a 30,000 net profit, and you would have to increase your discounted turnover by 75%. So your volume needs to increase by 75% to get to the same figure. So I think that's a really interesting slide. And I was sort of quite shocked when I went for all of this. And I think the thing to think about there is actually this is the same as giving sales agents commission. So if you take on board a sales rep and pay them 30% commission, this is the same scenario. So you need to be confident that they are going to increase your volume of sales by 75% to not be in a worse situation. Okay. And I should say that, as I mentioned right at the start there, this is a high margin business. If your margin is a low margin business or a lower margin company, then the situation is even worse. So going on to the next slide. So it's only a 30% gross margin here with overheads of 20,000 now. So we've got net profit of 10. If we did the 30% discount in that particular business, then you've completely wiped out all gross profit, which actually means that with your overheads, you're now in a loss making situation. I should have said net loss, not net profit. So hopefully that shows you the impact of offering discounts and getting sales agents in where you're giving a commission. And something else just to think about whilst we're talking about salespeople and paying commission is that sometimes they don't focus on how profitable the sales are that they are making, because they are incentivized based on that revenue, that turnover figure, not on whether it is a profitable sale. Okay. So that is something to look at. Sometimes I get asked, what does a finance director add, to my business? Well, that would be a classic example of where a finance director will go in and actually look at the profitability of your different service lines and work out where it is worth getting sales agents in, and potentially where it's not, or adjusting their commission structure accordingly. And another situation that can be quite tricky is if you don't have any clawback from your salespeople. So if they've made a sale, you've paid their commission, but then the sale gets credited in the future, or there's a problem with it, and there's no clawback because maybe it's been sold, missold potentially, or there are additional costs that have been incurred at a later date relating to that sale. If you haven't got a structure to actually monitor that, then actually that can cause sort of significant issues in your business. On a more positive note, however, if you put your prices up, you can actually afford to lose more sales than you might originally think. So, for example, if you increase your prices by 10%, you may expect that a 10% decrease in sales would mean that actually you're worse off. But doing the numbers, which luckily I've got on the next slide, there we go, you actually can afford for your volumes to decrease by 25% before they impact your bottom line. So I won't go through the numbers, but just take my word for it. If you calculate that out, do it at a later date, you get your 10K net profit with a 25% decrease in volume. Just conscious of time. If you do, however, want to go through this in more detail, then do reach out to me after the webinar, and I'll be happy to go through it with you. So another thing that we see with a lot of small business is that they lump the sales into one accounting code. So typically they've sort of started off doing one thing and they've started offering other service lines or other products, but those don't get split out. So it's kind of difficult to see. There's no visibility on the profitability of the different products or services they offer. We recently did a blog on this, which I'll hopefully put in the comments later. But just to sort of like talk through what we sort of talked about in the blog. Here's an example. So we've got a simple chart of accounts for a solar panel business, Eco Energy. And as you can see, they've got a turnover of 100,000 and cost of sales of 60,000. So gross profit 40,000. On the face of it, that's pretty good. You might not need to worry or care about that. But actually, as they've grown over time, they have started offering not just solar panel installations. They now offer, well, they have been offering for a while, sort of energy audits, and then also some consultancy services. So if they then were able to split out these three different service lines, they might have quite a shock, because you can see that actually, oops. I've got a delay on my two screens, and it means that I do it and then I get impatient and then I'll do it again. So apologies. But anyway, so we've now split out the three different service lines. And as you can see, the solar panel installations, which was their original business, is actually a tiny gross profit margin versus the energy audits that they do. And the consultancy is sort of standard 20%. So from this information, they can go, okay, well, how do we go about doing more energy audits, or how can we reduce some of the costs associated with the solar panel installations? So it just gives you that visibility to then help you make decisions to hopefully improve the profitability of the business going forward. So I think we've had enough death by PowerPoint for the time being. I'm going to stop showing that and talk about, I've alluded to it earlier, this whole matching concept. So a lot of business owners will get caught out by the concept of matching the income with the associated costs of that sale. And as you hopefully have seen earlier, it makes sense to understand what costs relate to what sales so that you can actually understand the profit of that sale. And the matching concept is a fundamental accounting principle, but in many SMEs, it doesn't happen, and so therefore, to a certain extent, your profit and loss account is a bit pointless if you are not matching your revenue with your costs. So let's have an example. We've got let's say a website company, a web developer company, and they receive a deposit from a customer for the service that they're going to perform the month or next month or the month after. So they get the money in, they've invoiced for the deposit. Deposit comes in month one, but in month two, that's when they're actually going to do the work to build the website. And the costs associated with building that website, let's say their contract costs, that is incurred in the month when you do the work. But the deposit that we've received now has actually been put straight to the profit and loss account. So at the moment, we've got, let's say, 100,000. In fact, I think I might have more deaf by PowerPoint, a slide just to show this. So yeah, so it's actually £1,000 here. So without the deferral of the income, we've actually got the deposit going straight to the P&L of £1,000. And your costs, your contractor costs, let's say, are then going out in the following month for 700. So you can see there that in month one, you're going to go, brilliant, I've got £1,000 coming in. This is amazing. I'll go out and buy some stuff because I've got all this money coming in. And then actually in month two, you suddenly realize that you've got this loss of 700, which is a bit of a bother because actually, you've got to spend half of it in month one when you think you've done so well. So, in that example, you can see that actually it makes much more sense to have both amounts in the month where the website building is happening. And to do that, you have to then do one of those manual adjustments. So you have to debit the P&L for the £1,000, you put it in the balance sheet, and then in month two, you then take out of the balance sheet and you put it into the P&L. Okay. I'm not going to go through the debits and credits for that in a load of detail, but that's where things can get complicated. And that's, as I said before, is where your accounts can get in a mess because these are manual adjustments. You can set your system up to then reverse journals, but some people don't. So if you haven't got someone keeping an eye on what has then gone into the balance sheet, you can end up having things in there that had been put in there in early periods that should have been released back to the profit and loss account, but then weren't ever released back. So that's just kind of an example of how your accounts can get in a little bit of a mess. But, it is important to do this to give you the understanding of how your business is doing. So as I mentioned at the start of this webinar, investors and banks place a lot of emphasis on EBITDA. And I absolutely love this waterfall chart that I think I was first introduced to it at the Goldman Sachs 10KSB program that I was on. But I think it shows it really well. But you can also see it on the left-hand side here as well. So as you can see, you've got your turnover, your cost of sales, gross profit, etc. Your EBITDA is your earnings before interest, tax, depreciation, and amortization. So as you can see, if you're now looking at the waterfall chart, you take your net profit and basically you add back your taxes, your interest, and your depreciation and amortization to get to your EBITDA. Or if you're looking at the left-hand column, you can see it comes in before all of those things go out. Okay. The left-hand column also shows some of the other terminology like EBIT and EBT, but I'm not going to go into those in any detail. But going back to your EBITDA, the reason why it gets looked at by investors is because it takes out your non-operating decisions, takes them out of the equation, and it looks at the underlying operational success of the business with the current sort of management team. And it's essentially looking to see how much cash is generated from your activities, not taking into account the decisions that you have made, let's say, to finance the business or your tax jurisdiction or any investments that you've made historically. So they're basically those decisions or your situation, those are taken out of the adjustment. So it's just looking at the operational efficiency of the business as you're currently looking at it, or its ability to generate income. And it also allows businesses to be compared on an international basis. So some businesses are going to be in a much more favourable tax jurisdiction than others. So the tax adjustment will sort of take that into account, just looking at the operational profit generation of the business. And so by looking at EBITDA, an investor can make an informed decision about the current management's team ability to generate cash from operating activities. And if you're a business owner looking to sell your business, I'll just take that down a sec. Stop sharing. If you're a business owner looking to sell your business, you're probably aware that your business will get valued on a multiple of EBITDA. But one thing that business owners sometimes don't appreciate is that, for example, if you're not paying yourself a market salary and you just take it in the form of dividends, then there will be an adjustment for that. So in a previous example, let's say you paid yourself a salary of £12,000, but the market rate for a managing director is, let's say, 150,000. So you would need to take off 138,000 from your EBITDA, which would then take it from 400k down to 262,000. Also, if you stop a service line or product, then the profit will be or loss will be adjusted accordingly. And also on a more positive note, if you've had exceptional costs, for example, redundancies, then they can get added back to EBITDA to give you sort of a valuation of your business. It is important to note that investors, though, won't look at EBITDA in isolation, and they will look at the overall financial health of the business, which would include looking at your balance sheet and your management account. So, as I said in the webinar that I did with Ramsey, we did look at some of the things in terms of the ratios that get looked at with the balance sheet. They tell you about sort of liquidity and things like that. But another area where business owners can get caught out is in regard to those management accounts, because an investor, let's say private equity investor, will look for a track record of producing those management accounts, typically over sort of a three to 5 year period. So if you haven't been doing that, you haven't got that history, then that's going to be a little bit of a problem, and you might need to get someone in to help you retrospectively create that picture, to create that history. And those management accounts shouldn't just be the profit and loss account. Your good reporting should include, KPIs, so a KPI dashboard with the key numbers for your business. Our first webinar was on this, so please do take a look at that. But it could also include the financial ratios that we talked about with Ramsey in the balance sheet webinar. You need to decide what the key metrics are for your business and have them as a dashboard, ideally. Your profit and loss account should really be broken down into those different service lines that I showed earlier, and should be compared against, ideally, your budget and also against last year. And ideally, you want to have it on sort of a monthly and a year-to-date basis. You should also be producing a balance sheet, just so that you are reconciling your key accounts and making sure that your control accounts are going back down to zero. So you want to have a look at that each month, and then also that cash flow forecast, so that forward-looking picture of how your cash is doing. And ideally, that's over sort of the next sort of 3 months, longer if you can do it, but it gets less relevant the longer you do it, because the numbers are sort of more made up, I guess, in the future. And when you're doing that cash flow forecast, you should really be looking to reforecast your known budgets, or you want to have your actuals year to date, and then your budget taking you into the future. But if you know that your budget that you did at the start of the year is wildly wrong, then you need to be adjusting those figures for your reforecast. So you still want to keep a comparison against your original budget, but you want to, for your forward-looking projections, you want to then do a revised forecast to give you a better picture of that. Pull back up my slides just to quickly, I'm conscious of time and we're getting way to the end, just quickly show you some examples of what that could look like. So here's your KPI dashboard with some key numbers on there, and your management accounts. So this is your profit and loss account. So comparing against budget last year, doing variance analysis. You're doing it for the month and year to date. And then your balance sheet. So just sort of a simple balance sheet there, where you've got last year and year to date, obviously. And then here is the cash flow. So where weeks 1, 2, and 3 there with your actual figures, and then you've got a position moving forward. And as you can see, you've got problems potentially in terms of week 4 and week 9, where you've got closing negative cash balance. So it's really, really important to have that. It's, if you're a cash generative business where you don't need to worry about cash flow, it's still useful to do that, because you should be making use of your cash by investing it to get a decent return. But definitely if you're a fast growing business where cash flow is tight, then this report is really, really important. So, as I said, really conscious of time. I think I've gone over, unfortunately. If there's anything that I've covered today, then please contact me on inquiries@artemisclark.co.uk. Really happy to have a conversation, either Teams or over the phone. We've also, last year, we launched a financial health check. So if there's anything that has made you think, oh gosh, actually I do think I need to have my finances looked at in a bit more detail, we've carved that out as a standalone service. So yeah, if you're interested in that, that is basically value of the time that we put in is about 3.5 grand, and we're currently offering it for 1,750. So if that is of interest, please do get in touch, and we'd be delighted to have a Teams meeting with you. That is completely free, to see whether it's the right thing for you and whether you want to work with us. But yeah, as I said, always happy to have a chat. If I can expand on any of this, then please do get in contact, and I look forward to hearing from you. And if you've got any suggestions about other webinar topics that you would like me to talk through, then also contact me on that email address, because yeah, I just want to do more of this content, which hopefully you found valuable. Thank you so much for your time, and I'll see you at the next one. Take care. Thank you. Bye.